Have you ever wondered how stock trading works? Well, you're not alone. The world of stock trading can seem like a complex labyrinth, but it's not as intimidating as it may appear. It's a vibrant ecosystem where investors buy and sell shares of public companies, contributing to the pulse of the global economy. Stock trading is essentially buying a piece of a company. When you buy a stock, you're buying a small fraction of that company, becoming a shareholder. As a shareholder, you're entitled to a portion of the company's earnings and assets. Now, you might be thinking, isn't stock trading only for the rich or the financially savvy? A common misconception, but not entirely true. Sure, having a hefty bank account can give you a head start, but it's not the sole requirement. The stock market is democratic. It's open to anyone willing to learn, understand, and take calculated risks. Think of stock trading as a game of chess. It's not about the size of the pieces you start with, but how you strategically move them across the board. Financial savvy, yes, it's beneficial, but guess what? It's not an inherent trait, it's learned. And that's precisely what we're here to do. Stock trading plays a crucial role in the economy, a role that goes beyond individual gains or losses. It allows companies to raise capital for expansion, for research, for innovation. It's a catalyst for growth, spurring economic activity, creating jobs and fostering technological advancements. But let's not sugarcoat it. Stock trading involves risks. It's not a ticket to instant wealth, nor is it a guaranteed path to financial ruin. It's a journey of understanding market trends, economic indicators, and company performance. It's about making informed decisions, not just rolling the dice and hoping for the best. So, buckle up and get ready to dive into the fascinating world of stock trading. By the end of this video, you will understand the basic principles of stock trading. Before diving into trading, it's crucial to understand what stocks are. So let's peel back the layers and get to the core of it. At its most basic, a stock represents ownership in a company. When you buy a stock, you're buying a piece of that company, becoming a shareholder. It's like having a slice of a gigantic corporate pie. The size of your slice depends on how many shares you own compared to the total number of shares issued by the company. Now, not all companies have stocks. There's a difference between public and private companies. Private companies are just that, private. They are typically owned by a small group of people, like the company's founders, a handful of investors, or perhaps employees. These companies do not sell shares to the public. On the other hand, public companies have sold at least a portion of themselves to the public through an initial public offering, or IPO. This is when you hear about a company going public. Once a company goes public, its stock is traded on one of the major stock exchanges, and anyone, including you, can buy a piece of that company. But why would a company sell shares of itself? Well, companies typically go public to raise money, and they use that money to grow, innovate, or maybe pay off debt. And in return, they offer a potential profit to those who buy their stocks. Stocks fluctuate in value based on supply and demand. If a company's doing well, more people will want to buy its stock and the price will go up. Conversely, if a company's doing poorly, people may want to sell its stock and the price will go down. Remember, when you buy stocks, you're not just buying a piece of paper or a digital entry in an online account. You're buying a piece of a company with the hope that the company does well and your stock increases in value over time. Now that you understand what stocks are, let's move on to how they're traded. The stock market is where buyers and sellers meet to trade stocks. It's a bustling, vibrant marketplace, not unlike a busy town square, where transactions take place not in fruits or fabrics, but in shares of companies. Now, you might be wondering, where does all this trading actually happen? The answer lies in stock exchanges. These are the platforms where investors from around the globe come to buy and sell shares. They act as a facilitator, a mediator of sorts, ensuring that trading happens smoothly and efficiently. Some of the most prominent stock exchanges include the New York Stock Exchange, or NYSE, and the Nasdaq. The NYSE, with its iconic Wall Street address, is the largest stock exchange in the world by market capitalization, hosting some of the biggest companies globally. The Nasdaq, on the other hand, is known for being tech-heavy, with giants like Apple, Amazon, and Google calling it home. But it's not just about these two. There are dozens of stock exchanges worldwide, each with its unique characteristics. For instance, the London Stock Exchange is one of the oldest, dating back to 1698, while the Tokyo Stock Exchange is the largest in Asia. These exchanges provide a level playing field for buyers and sellers. They ensure transparency, provide up-to-date price information, and enforce rules for trading. This makes the stock market a relatively safe place to trade, despite the inherent risks of investing. It's important to note that you, as an individual investor, won't be standing on the trading floor, shouting out orders like you see in the movies. Instead, you'll be conducting your trades digitally through a broker from the comfort of your home or office, but we'll delve more into that in the next segment. In essence, the stock market is a dynamic ecosystem. It's the beating heart of the global economy, where companies raise capital to grow and investors, big and small, strive to grow their wealth. With a basic understanding of the stock market, we can now look at how to actually trade stocks. To trade stocks, you need a broker and a trading account. So who or what exactly is a broker? Picture a broker as a middleman, a facilitator of sorts. They're the ones bridging the gap between you, the investor, and the stock market. Without a broker, you'd have no way of buying or selling stocks. They're the ones who execute your trades, acting on your instructions to buy or sell specific stocks. Now, there are two main types of brokers: full-service brokers and discount brokers. Full-service brokers offer a wide range of services such as retirement planning, tax advice, and investment recommendations. They're your go-to if you're looking for a comprehensive, hands-on approach to investing. On the other hand, discount brokers offer fewer services but charge lower fees. They're ideal if you have a good grasp of the stock market and prefer to make your own investment decisions. Now, let's talk about trading accounts. This is your personal interface with the stock market. It's where you'll deposit your money to buy stocks, and it's where your stocks will be stored. Setting up a trading account is relatively simple. You'll need to provide some basic information like your name, address, and social security number. Some brokers might also require proof of income and an initial deposit. Once your account is set up, you'll be able to start trading. You'll have access to a range of tools to help you make informed decisions. These might include real-time stock quotes, research reports, and analytical tools. Remember, trading involves risk, so it's important to do your homework and make informed decisions. It's also worth noting that many brokers offer demo accounts. These let you practice trading with virtual money before you dive into the real thing. They're a great way to get a feel for the stock market without risking any of your hard-earned cash. So there you have it. Brokers and trading accounts are the gateways to the stock market. They're the tools you need to start buying and selling stocks. With your account set up, you're ready to start trading. Buying and selling stocks might seem complex, but it's actually quite simple. Let's break it down. When you're ready to start trading, you have a few options. You can place a market order, a limit order, or a stop order. Each one has its own advantages and potential pitfalls. A market order is like buying groceries. You see the price tag, you agree to pay that amount, and the transaction happens immediately. However, with stocks, the price can change in seconds. That's why when you place a market order, you're agreeing to buy or sell a stock at the best available price at that moment. It's fast and straightforward, but the price you get might not be the price you saw when you decided to make the trade. A limit order, on the other hand, is like setting a budget for your shopping. You specify the highest price you're willing to pay or the lowest price you're willing to sell at. Your order will only be executed if the market price reaches your specified limit. While this gives you control over the price, there's a risk that the market may not reach your limit and your order may not be filled. A stop order is a bit like an emergency brake. You set a price at which you want to buy or sell. If the stock reaches this price, your stop order becomes a market order and is executed at the best available price. This can help limit losses or lock in profits, but like a market order, you might not get the exact price you set. So which one should you use? Well, it depends on your trading strategy and risk tolerance. Market orders are great for speed, limit orders for control, and stop orders for protection. Remember, the stock market is not a casino. It's a platform for investing in businesses. Your trading decisions should be based on careful analysis, not blind luck. Now that you know how to buy and sell stocks, let's discuss when to do so. Timing is everything in stock trading. This phrase has been echoed by seasoned traders and financial experts across the globe, and for good reason. In the world of stock trading, the difference between a profitable trade and a losing one often boils down to timing. Think of it this way: the stock market is like a giant, ever-changing puzzle. The pieces are constantly moving, driven by factors such as economic indicators, company earnings, and global events. Your role as a trader is to solve that puzzle, to find the right moments to buy and sell. Now let's delve a bit deeper into this concept. You've probably heard the phrase buy low, sell high. It's the most basic principle in stock trading, but how do you know when a stock is low enough to buy or high enough to sell? That, my friends, is where timing comes in. Let's break it down. When we say buy low, we're talking about purchasing a stock when its price is at a relative low point. This could be due to a number of factors, such as a temporary downturn in the company's performance or a broader market decline. The key here is to identify these low points and seize the opportunity to buy. On the flip side, sell high refers to selling a stock when its price is at a relative high point. This could be when the company reports stellar earnings, or when the overall market is on an upswing. Spotting these high points requires a keen eye for trends and an understanding of market dynamics. But remember, timing the market perfectly is nearly impossible. Even the most experienced traders can't predict market movements with absolute certainty. That's why it's crucial to combine your timing strategies with solid research, risk management, and a well-diversified portfolio. In conclusion, timing your trades is an art that requires practice and patience. It's about understanding the market, recognizing opportunities, and making informed decisions. So while timing is indeed everything, don't forget, understanding when to trade is just as important as knowing how to trade. Stock trading involves risk, but there are ways to manage it. Just like a seasoned sailor navigates the stormy seas, an astute investor can steer through the volatile waves of the stock market. Let's explore how. First off, diversification. This is the practice of spreading your investments across a variety of stocks, sectors, or asset classes. Imagine a basket of apples. If one apple goes bad, it doesn't ruin the whole basket. Similarly, if one of your stocks underperforms, it won't sink your entire portfolio. Diversification acts as a safety net, cushioning the potential losses from any one investment. Next up, stop-loss orders. This is a tool that can help you avoid significant losses. By setting a predetermined selling price for a stock, you ensure it's automatically sold. If the price falls to that level, it's like having a personal guard standing by to sell your stocks if things start to go south. Remember, the goal is not just to make profits, but also to protect what you have. Another strategy is to keep a close eye on market trends and economic indicators. Knowledge is power, after all. Staying informed about market movements and economic developments can help you make better decisions and manage risk effectively. And last but not least, don't forget to review and adjust your portfolio regularly. The stock market is a dynamic entity, constantly evolving and changing. Your portfolio should be too. Regular reviews allow you to weed out underperforming stocks and capitalize on new opportunities. Remember, risk is an inherent part of stock trading, but with thoughtful strategies like diversification, stop-loss orders, staying informed, and regular portfolio reviews, you can manage these risks and navigate the market with confidence. Risk management is key to successful stock trading. It's not about avoiding risk altogether, but about understanding it, controlling it, and making it work for you. After all, as the saying goes, no risk, no reward. Diversification is a powerful tool for managing risk in your portfolio. Think of it as not putting all your eggs in one basket. By spreading your investments across a mix of different assets, you're essentially reducing the risk that comes with relying on just one or two investments. This is the heart of diversification. So, how does diversification work? Let's break it down. When you diversify, you're investing in a variety of assets. These could be different types of stocks, bonds, real estate, and more. The idea is that if one investment performs poorly, the others could do well and offset the loss. This helps to smooth out the bumps in the road and can lead to more stable returns over time. Now, building a diversified portfolio isn't just about randomly picking different investments. It's a strategic process that takes into account your financial goals, risk tolerance, and investment horizon. Start by determining the right mix of asset classes for you. This is called your asset allocation. For instance, if you're a risk taker and you've got time on your side, you might have a higher percentage of stocks in your portfolio. On the other hand, if you're nearing retirement, you might lean more towards bonds, which are typically less volatile. Next, diversify within each asset class. Instead of investing in just one stock or bond, spread your money across several. This could mean buying shares in companies from different industries or purchasing bonds with varying maturities. Lastly, remember to rebalance your portfolio periodically. Over time, some investments may outperform others, throwing off your original asset allocation. By rebalancing, you're bringing your portfolio back in line with your investment strategy. Remember, though diversification can help manage risk, it doesn't guarantee profits or protect against loss in a declining market. It's always wise to carefully consider your investments and consult with a financial advisor if needed. With a diversified portfolio, you're well equipped to navigate the ups and downs of the stock market. Let's recap what we've learned about stock trading. We began by understanding what stocks are. Simply put, they're shares in the ownership of a company, representing a claim on part of the company's assets and earnings. Think of it as your very own slice of the corporate pie. Next, we ventured into the bustling world of the stock market. This is where buyers and sellers meet to trade stocks. The market operates much like an auction house, with bids and asks driving the price of stocks. Remember, the market is influenced by a myriad of factors, from economic indicators to company news and even global events. We then delved into the role of brokers and trading accounts. Brokers, both traditional and online, are the gatekeepers to the stock market. They facilitate your trades, for a fee of course. A trading account, on the other hand, is your personal interface with the market. It's where you'll execute your buy and sell orders. The heart of our journey was understanding the mechanics of buying and selling stocks. We learned that buying a stock means you believe in the company's potential for growth, while selling a stock generally means you're cashing in on your investment or cutting your losses. Timing your trades was our next stop. We learned that in the stock market, timing can be everything. But remember, it's not about timing the market perfectly. It's about time in the market, because the longer you're invested, the more potential your money has to grow. We also discussed the importance of risk management. Investing in stocks comes with risks, but with careful planning and disciplined investing, you can manage and mitigate these risks. And lastly, we examined the concept of diversification. By spreading your investments across different types of stocks, you can cushion potential losses. Think of it as not putting all your eggs in one basket. With this knowledge, you're now ready to start your stock trading journey. Remember, practice makes perfect.